Hello, this is Doc Severson for the TheoTrade report for Thursday, November 17th. I'm going to start off tonight with the S&P 500. These are the futures contracts in here, and it's important that we use this particular instrument because you can see just the move that we had off of the election. So the election move has been about probably an 8% move here. And it's been good for about 150 handles so far. And it doesn't seem to be slowing down at this point. So even though we are coming up to all-time highs, we have other indices that are out there breaking all-time highs and charging forward into new territory. So often when we have an index like this that's just taking off, it's helpful to look back at the sector spiders in this case to understand really what sectors are taking off. And I'll start off with that with the XLB, which is the building materials. And we've had a modest rally since the election, but nothing really to write home about. Now, XLE is still kind of stuck in place right now. Still kind of stuck in this range and waiting to see if we can get the XLE to get moving here. This one is definitely well off of its highs in 2014 and still waiting to see whether or not this is just going to roll over as another lower high in the monthly chart, or whether this is going to take this consolidation and start to break higher from here. But energy is definitely weighing down the market right now. XLF, on the other hand, is going ballistic right now, and this is because of all this consolidation. If you think about it, it makes sense because of the fact that the banks, which have really had no margin to be able to work with in terms of interest rates, all of a sudden, looking forward, they're going to have a lot of room to work with on interest rate. So this, of course, is based on the assumption that growth is going to come back in and we might be able to get into a rising rate environment again. So this is what the market is basically discounting right now, is that with the new administration and with everything else that's falling into place right now, that this might be a strong period of growth going forward over the next 12 months. Now, I've had some people ask me saying, this makes no sense at all. This guy is not even in office yet. He just got elected a week ago and the market's going off like this. He hasn't done a single thing. Well, when did the market ever wait for something tangible to actually occur? It's always going to be well ahead of the actual event. It is a discounting mechanism. So the financials have really had a heck of a move and are still relatively cheap right now. Here is one of the new ones, the XLFS, the financial services sector under here. And of course, this one also is moving very, very strongly. Now, be careful if you were to think about trading this one with options, as looking at the option chain for this, they're not too liquid. So you can see some of the open interest in liquidity right now is very, very low. The spreads are wide. I would avoid trading the XLFS with options for right now. Okay, the next sector is industrials, XLI, and this is much like the Dow chart, the Dow Industrials, is that this is probing new all-time highs. So obviously, this is discounting perhaps the new infrastructure projects that have been bandied about lately. So whether or not they actually occur, whether or not they actually get paid for, it doesn't matter. All we're looking at is forward projection here that this could happen. Now, technology has not really been going anywhere at all lately. This is the XLK, and this is very much like the NASDAQ chart, where I think a lot of the XLK or technology has been cannibalized lately to clear funds to be able to rotate into other assets, say like financials, right? So XLK is not really necessarily responsible for much lately. XLP, which is consumer staples, has had such a strong run. Again, this is a case where people are cannibalizing against XLP and consumer staples to rotate into other assets. Here's the next sector, which is the real estate REIT. And again, this is not really responsible for much of anything lately. Also, same deal here. Do not look to trade this with options. With bid-ask spreads of 15 cents by $1.20, you don't want to touch these. So regardless of the fact that this is technically now an S&P sector spider, you don't want to be trading it. So now we're going to go to the XLU, the utilities, and this one was very strong for a while here because of the fact that these were heavy dividend payers, but people don't want dividends when growth is available, so these again have also been cannibalized somewhat lately to rotate into different sectors. Now we get into healthcare. What's going to happen with healthcare? A little bit of a bounce here. Healthcare is not going to go away. Could get reshuffled in the near future. But again, modest bounce here. This is definitely responsible for some of the S&P's gains lately. And so we'll get out to the final one here, which is the XLY, which is consumer discretionary. Now think about this one for a second. Consumer discretionary has been very strong over the last few days and responsible for a big chunk of the gains of the S&P 500. So this is actually also a good sign that discretionary, look at the rally on this thing, and it still appears to be heading higher from here, very close to all-time highs. Now, before I close out today, so that was all the sectors, and we could see where the money's coming from, where the money's flowing to, and so now we'll finish up on the S&P 500 ETF by itself. Again, very, very close to all-time highs. Might have some difficulty getting into the 220 area, so we're very close to that. We're at 2200 on the full S&Ps. So we're going to be more than likely sort of taking a pause here as we get into the next week for a chance to recharge. Markets don't, tack on 8% over the course of a week without perhaps taking a rest going forward. You can't get all those gains all at once every single day. So remember what's going on here. Step back for a second, understand what's actually happening here. The market is rallying like crazy based on speculation that perhaps some more pro-growth strategies are going to be in place, perhaps some less restrictive regulatory environment is going to be in place going forward. All of these things are generally pro-market. There is not one single tangible thing for the market to hang its hat on right now, other than just words. And so what I'm anticipating going forward is that, yes, we may rally on the rumor, but the first disappointment, you can bet that we're going to see volatility. You can bet that we're going to see volatility out of this. And so I'm anticipating the next 6 months are probably going to be more volatile than we've used to. Certainly since this summer, where we had literally all the volatility, all the lifeblood drained out of this market. I think we're going to get it back again here in the next 6 months. I think this is going to be an extraordinarily interesting time. And right now, last thing I want to bring up is the Russell is into all-time highs. And this is a very strong signal that asset managers, fund managers, are putting money to work again in the riskiest assets. And that's a strong indicator for the market right now that is definitely buying the rumor. All right, that is it for today's report. Thanks for listening, folks, and we'll see you this weekend in the Weekend Report. Take care.